What's the thesis around Humba?
Humba was born out of a long time being an engineer. I've been interested in like deep tech and science and like kind of interesting, more technical applications. It just seemed like a good time to start investing in deep tech. And so it's pretty different to start looking at like robotics companies or space or biotech.
What are the biggest lies out there?
Everybody said like basically like don't send founders feedback because the idea was like, well, like if they don't like your feedback, like they won't want to talk to you next time. And I found that kind of like intellectually unsatisfying. And so pretty early on, I started sending feedback to founders and like people really liked it. Most people don't really know what they're doing. And like they make an appearance like they do, but I think when you really dig in, like we're all just like trying to like, fake it till we make it.
One should always diversify their sourcing channel. Why that's important and how to go about it.
I think diversification of sourcing is important just because if you really rely on a source or two, like you're kind of subject to the whims of what happens with that sourcing channel. Now it's like, well, that was, a good chunk of your deal flow and it just disappeared. If you're just overly reliant on one or two channels, like that's a risk you're taking. If you have like 10 or 20 channels, even if one goes away, it doesn't affect you too much.
The conversation was Leo Polowitz, was a lot of fun. Leo is a co-founder and general partner at Susa Ventures and Humba Ventures. He writes between 1 million to 3 million checks via Susa, mostly in B2B SaaS companies, and 250 to 500K checks via Humba, mostly in deep tech and in critical sectors like manufacturing, energy, defense. During our conversation, we mostly covered Leo's reflections, learnings, and mistakes from building Susa and Humba Ventures over the last 10 plus years. What led him to start Humba Ventures, biggest lies told in the VC world, most underrated advice for fundraising, why it's super important to have diversified channels for deal flow, who is the outsider work, and much more. Now I bring you Leo. Awesome. Leo, so excited to have you on the podcast.
Thanks, Shiv. I'm excited to be here and to chat with you.
Yeah, as we were discussing earlier, I personally got to learn a ton from you. Of all the writings you've put out on the internet around building a venture capital fund. So Leo, maybe a good starting point would be, what led you into investing, and what was the founding story initially of Susa Ventures?
Yeah, it's a good question. To be honest, I think like most VCs, it was sort of a mix of luck and serendipity. So had been an engineer for about a decade. I was early at a couple of startups where I was there at the 15 to 50 person phase. One of those startups was LinkedIn. Another one was called Factual, and it's a company that merged with Foursquare a few years ago. And so I like startups a lot. I was thinking about starting my own, but I felt like I kept seeing this like 15, 20, 30 person phase, and I'd never seen what it was like when the startup was just getting off the ground. It was just one or two people. And so I wanted to learn more about that. And I had a couple of friends that were angel investing at the time. They didn't have a fund yet, but they were thinking of starting a fund. But they wanted a technical person on the team to help with technical due diligence. Mm-hmm. And so when I left the second startup I was at, they invited me to join their angel group. And I thought, oh, this is great. Like, I want to start a company, but, I don't know anything about the 2-3 person phase. Maybe if I do some angel investing for 6 months or a year, I'll learn a lot and then I'll go start a company. And I'll be better equipped for it. And so that was the plan. So I ended up angel investing with this group for a while. After like 6-7 months, we realized, we liked working together a lot. We liked, the business of investing a lot. So we ended up starting to raise our first fund, Susa Ventures, back in 2013, after about 6-7 months of working together. And I was still thinking like maybe, in a little bit, I'd go spin off and start a company. But just the more I did VC as that first fund started, the more I, just really grew to love it. I love working with founders. I love learning about interesting companies and technologies. And so, now it's been, instead of a couple months or a year, it's been about 11, 12 years now. Mm-hmm. And, it's definitely a lifetime career for me and something I really enjoy and something I'm excited to keep doing for a couple more decades.
Got it. And Leo, I think we are on the Fund 5 at Susa. So I think we'll cover more around your learnings, your reflections, your mistakes around it. What was the portfolio construction and the thesis of Susa Ventures, and has it evolved over time? Has it changed over time? If so, how have you thought through it?
Yeah, the So the portfolio construction was about the first fund was 25 million. The plan is to do about 40 companies initially, and then we'd reserve about half the fund for follow-on. And that was the plan on day one. We roughly like stuck to that. I think we ended up with 41 companies instead of 40. And
Mm-hmm.
the average check size was like 260K instead of 250K that we planned. But it was
Yeah.
basically like what we planned. And the thesis has evolved a little bit, but not too much. So initially, a few of us came from the world of data, and this was back in the early 2010s, where there weren't a lot of funds with like a data-oriented investing thesis. And so initially, what Susa was investing in was companies that use data as a competitive advantage, or basically where like data could be a moat.
Yeah.
And so kind of anything that used, machine learning or you're aggregating interesting data from customers, like that was in scope for us. So we invested behind that thesis for a few years. After a while, we kind of realized like we like data as a competitive advantage. We also just like strong competitive advantages in general. So we
Mm-hmm.
kind of have broadened it to data, network effects, economies of scale, kind of anything, any company where they could build a strong, durable moat over time.
Mm-hmm.
And so that's basically been the thesis for the last 10, 11 years at Susa. Um, I'd say the one thing that's changed or evolved a little bit too is in the beginning we were very generalist, so we kind of pretty open investing in any sector. In the first couple of years, we hit a lot of our big early successes. So like we were seed investors in Robinhood, that was like a year one investment. We were seed investors in Flexport, that was year one investment. Those are like fintech and logistics. And what we saw is like once we start investing in these companies, the ones that start doing well, whatever sector they're in, we start getting more inbound deal flow. Like founders are more eager to work with us, like
Mm-hmm.
later stage investors will look more at what we're doing. So as we saw like successes in a couple of these early sectors, we ended up just doubling down on them more and more. And
Yeah.
so we're still a generalist fund, but I would say like there's 4 or 5 categories we really look at Susa. So it'd
Mm-hmm.
be like B2B SaaS, healthcare, fintech, logistics, some dev tools that we're been increasing over time. But like those 5 areas are basically where we spend most of our time, and it's a reflection of like where we've had more success, where we feel like we see better deal flow, or like founders are more excited to work with us.
Mm-hmm.
So that's kind of been the evolution of the thesis over the last decade.
Got it. And talking about Humba Ventures, Leo, what's the thesis around Humba, and what's the portfolio construction around it?
Yeah. So over the years, once in a while, like if we see an interesting opportunity and we feel like maybe it's not quite a fit for like Susa's portfolio construction, historically we've started a new fund around like that opportunity. And so this first happened about 5, 6 years ago. We started our first opportunity fund, which basically does larger checks in Series A and B.
Yeah.
And we felt like it should be, a separate fund because it's going to have a different return profile. You probably want a different team around it, like people that have experience at Series A and B investing, looking at
Mm-hmm.
financials, that kind of thing, versus maybe like pre-seed and seed investing, where it's more based on the idea and the founder and not traction. And that's been going quite well. That fund, we're going to start a fund 3 there pretty soon.
Mm-hmm.
And then Humba was born out of, for a long time being an engineer, I've been interested in like deep tech and science and like kind of interesting, more technical applications. And it'd been pretty hard to invest in those sectors when Susa was first starting, just because there weren't a lot of companies in these areas. There wasn't a lot of follow on capital. We didn't have a multi stage fund. So, it's like if there's no follow on capital, like we can't be the follow on capital. And so
Yeah.
the companies would just get stuck. Um, but a couple of years ago, I felt like that was starting to change. Like there's more follow-on funding across stages. There are all these great founders spinning out from like SpaceX and Palantir and Tesla and these great companies. And so it just seemed like a good time to start investing in deep tech.
Mm-hmm.
But it also felt like maybe a different skill set than what we'd grown around the Susa team, because
Yeah.
Susa is really focused on software. Like fintech, healthcare, SaaS, like those are all software areas. And so it's pretty different to start looking at like robotics companies or space or biotech. So it kind of felt like if we started a fund there, first maybe we should start with a different check size and like not just start trying to lead rounds right away, and really like build a brand and reputation in deep tech.
Mm-hmm.
Also felt like maybe that team would be a little bit different on the investing side. Like it would
Yeah.
be more, science PhDs or like
Mm-hmm.
engineers or folks like that. So basically, we started Humba Ventures around that about 2.5 years ago.
Yeah.
It's a slightly smaller fund. It's 40 million in the most recent fund, and basically it's just deep tech investing and investing, across these areas where basically there's a lot more like science and engineering risk than most
Mm-hmm.
traditional software companies.
Got it. And talking about fundraise, Leo, I mean, you've raised, maybe what, seven, eight, nine funds now across the family of Susa Ventures. What do you think? Okay, let's start with this. What's the most overrated, uh, advice that you've heard about fundraising for funds?
Ooh, that's a good one. To be honest, I feel like I've heard more underrated advice than overrated advice. Because for the most part, the advice I've heard has played out, even when I didn't think it would play out.
Yeah.
So maybe I'll flip the question a little bit. On the underrated side, I think meeting LPs, especially institutional LPs early, is a piece of advice we've gotten like since day one.
Yeah.
Um, and I think that's really worked out well for us, and it's worked for a lot of my peers as well. Where a lot of institutions like fund of funds, they probably won't invest the first time they meet you, and
Hmm.
often not even the second or third time. But if they've known you for a few years, they're much more likely to invest. So
Yeah.
even when you're raising fund one, if you don't think institutions will come in, like you should still talk to them,
Yeah.
because they're not going to invest in fund two if they just meet you in fund two, but they might invest if they met you in fund one and have gotten to know you for a few
Yeah.
years. So I think that's like one underrated piece of advice. I think another one is like I wish we had front loaded management fees a little bit in our first fund,
Yeah.
because the first fund wasn't too big. We had four GPs. The management fees like didn't go very far in terms of salaries and expenses, and I wish we'd done like 2.5 or 3% instead of 2%, and
Hmm.
then just tapered off faster at the end. So I think that would be another piece of advice that I kind of hear thrown around a little bit, but I think it's like very much worth taking and underrated.
Got it. Got it. Leo, let's say you were starting, raising a fund now. Given all the learnings that you've gotten, how would you go about, sourcing LPs, building relationships with LPs, and closing LPs?
Yeah, it's a good question. It's probably a little bit different from us because we've had LPs we've been working with for over a decade now at Susa, and
Yeah.
so a lot of times whether we're raising a new fund that's like Susa's next fund, or something like Humba or Opportunity Fund, Kivu,
Yeah.
um, in those cases a lot of times like we'll go back to the investor base, and that's like a lot of the fundraising is just talking to them about whatever we're doing next.
Uh-huh.
Um, I think if I was starting from scratch, there's some great conferences out there. Like I think there's one called Raise that I've heard really good things about that connect
Hmm.
LPs and emerging managers. Um, I think swapping LP lists with fellow fund managers has been really useful,
Hmm.
especially if they're kind of it works both with people that are peers in terms of you're raising a first or second fund and so are they. A
Yeah.
lot of times you both know LPs that are maybe interested in new emerging managers, but you'll know different LPs, so you can kind of swap lists, and I think it's a win-win.
Hmm.
um, I think the other one that works is like if you go to like a friend that's a more experienced manager and they're in four or five or six, a lot of times their more recent funds are, they raise quickly, they're oversubscribed, but
Yeah.
then, LPs trust them. And, if those people like recommend your fund to LPs, like that can go a long way.
Hmm.
So I think like just talking to other GPs is a good strategy. Um, I'm trying to think of what else. I also think whenever you get an LP, ask them for like referrals and
Well,
recommendations, right?
yeah.
I think that's something that's worked well.
Got it. And what was the hardest lesson, or let's put it this way, the biggest mistake that you did as a group when you were fundraising and you realized it later on?
I do think so. Again, I'm glad we went to institutions early on Fund One, um, but in the beginning, I would say we spent a lot of time on them because we thought we could convince them to invest,
Yeah.
and we didn't view it as like a relationship building thing. We thought of it as like, hey, maybe they'll invest in Fund One, and I think we spent the first couple of months, sort of chasing investors that I think frankly wouldn't invest in a Fund One
Yeah.
most of the time. Um, so I think that was probably like one of our bigger mistakes is just like not prioritizing the fundraising time well, just for the first couple of months, and then we learned pretty quickly after that. Um, I think the other one, maybe this is more on the Humba side than the Susa side, is um, like Humba's focused on deep tech, and some LPs are interested in it. Some are very interested in deep tech. Some are like pretty skeptical. Uh, I think what I found, after a couple of months of fundraising is like the LPs that are skeptical, it's generally a waste of time to try to convince them.
Hmm.
Um, because they're only going to say yes to like one or two or three funds a year most of the time. And, if they meet a few hundred funds and if they start skeptical on yours, the chance that you can convince them that you're one of the one or two or three best ones they'll see all year is pretty slim. So
Hmm.
I think it's better to just like focus your time on the LPs that are, pretty interested or very interested in whatever you're doing from day one.
Got it. Moving on to the core of investing, which is sourcing, picking, and winning. Leo, over the years, how have you improved over the years in each segment, which is around sourcing? I think one recently you tweeted that one should always diversify their sourcing channel. Why maybe we can double click on that as well, why that's important and how to go about it.
Mhm. I think diversification of sourcing is important just because if you really rely on a source or two, like you're kind of subject to the whims of what happens with that sourcing channel.
Yeah.
Right. So like, for example, like maybe there's like, two or three funds where they send you great stuff, but then those funds grow up and now you're competitive instead of complementary. Or maybe like your best friend at, one of those funds like leaves venture capital or goes somewhere else.
Yeah.
And so like now it's like, well, that was, a good chunk of your deal flow and it just disappeared.
Yeah.
Or same thing with accelerators, for example. Like there's accelerators where they have good years and bad years, or like maybe they start strong and get weaker. Maybe maybe they don't start so strong and get better. If you really depend on an accelerator and then that accelerator evolves, like maybe the
Hmm.
deals no longer fit what you're
Yeah.
investing in. Maybe the companies aren't as good as they were 5 years ago. So again, like if you're just overly reliant on one or two channels, like that's a risk you're taking.
Hmm.
On the flip side, if you have like 10 or 20 channels, even if one goes away, it doesn't affect you too much. And then additionally, you get to see like, more variety, right? Because if you have, one channel, like let's say it's your best friend at another fund that's like,
Yeah.
very active, like you only see the stuff they see. And so, like maybe that's good, but maybe you miss out on a lot of things. But the more channel diversity you have, the better coverage your will be. Um, in terms of sourcing, I mean, I think like it's evolved a lot over time for us. Part of it is just adding new channels. So when we started, most of the deal flow we got was from other VCs, because we were writing small checks. We tried to make friends with lead checks where they would do like 75% of a round, and then they try to find good like value add investors to fill out the rest. And we basically talk to the larger VCs and we try to convince them that we were a good value add partner and like we weren't competitive, we were complementary, and that worked pretty well for the first couple of years. That was where we like found a lot of our best early investments. But then as we grew up, sometimes like that relationship with other investors was no longer
It
complementary.
changes. Yeah.
Yeah, and so we got less deal flow from them. But I think what happened is we started getting more deal flow from smaller funds, right? Because the role kind of shifted,
Yeah.
where we went from being a participant to being a lead, and then once we're the lead, like we'll bring in smaller funds, but also smaller funds might bring us into lead around where like their check size is not big enough to lead.
Yeah.
So I think we started getting more deal flow from smaller investors. As our portfolio grew, we started getting more deal flow from founders we worked with. I would say like, one lesson here is like, sometimes you just got to remind people that you're always looking, right? Cause like you work with a lot of founders and maybe like it doesn't, like maybe they're not thinking about your business day to day. They're thinking about their business.
Yeah.
So they might not realize like, hey, if they have a friend that's fundraising, like they should introduce them to you. Right. So like just kind of being proactive and reminding people of that, I think has been a good lesson and a good thing to do.
Yeah.
Um, I think over time, like, dinners, conferences, blogging, like all these other things, like we've tried them. Some of them work, some of them don't. I'd also say like some of them work for different people.
Yeah.
So like I don't like in-person stuff in conferences, so I tend to be more online. My partners tend to be the opposite. Like they love conferences and events and like retreats, and then they're less active on like Twitter or blogs and things. And so I
Yeah.
think part of it's also just finding sourcing channels that are like authentic to you and work well for you.
Got it. And Leo, if there's one way, what's the best way to build a great deal flow? Over that's something that you've learned, over the last 10, 12 years. Is it just
I,
share the best deals with others? They'll share it back with you.
I think that's part of it. I mean, I think that definitely helps. I think a big thing is to just be like have a distinct brand and reputation for something.
Yeah,
Um, and it might be that like you know some area very well, right? Or it might be that you're very experienced in some like function where like founders want help with that function.
yeah,
And I think if you're regarded as like one of the best investors to talk to for a certain space or like skill, I think that's where you get really good deal flow because you get it from investors that like someone else. Like let's say you're really good at like I don't know product marketing. So what happens is, and you have like a very specific brand around it where you're like, hey, I'm the product marketing VC. What happens is every time a fund is like leading around and the founder is like, I need help with product marketing, they're like, oh, you should talk to Shiva.
yeah,
And similar, like every time a founder is like, oh, like, I'm good at everything. I wish I could help, like get help with product marketing. They think of you. And I think that's like a really good place to be. Um, because I think that's where like you get good inbound from like founders, investors, like people are excited to work with you. You get better access. So if you do commit to an investment, you're more likely to get in. So I think like having a good, like concrete brand is, I think, really helpful.
yeah. Got it. And Leo, how to go about, we all talk about uh, having a unique value proposition, which really what that means is having a brand around something. Uh, how one can think about building a brand in this space?
Yeah, I think a lot of it's consistency and then like just being public about whatever it is that whatever your brand like you want your brand to be, right? So for example, like if it is product marketing, it's putting out good content with for product marketing. It's being on like product marketing panels. It's
Mhm.
having some founder be like tweet that like, oh, like this is the investor that helped me the most on this, or like here's like an example of how like this person helped me on product marketing. So it's like a lot of it's just like having a message and then just getting it out as many ways as possible, right? Like can you get like a founder's TechCrunch funding announcement to mention that you really helped them in some area? Can you get someone to tweet about you? Can you be on a panel? Can you write some blog posts? And
Mhm.
I think the more prolific you are in an area, like I think the stronger that brand becomes.
Yeah,
Um, probably a good example of this would be like Jason Lemkin for SaaS. Like he has just been blogging about SaaS, for like 12 years or something.
yeah.
And he's got like 1,000 posts. And whenever somebody thinks of SaaS and sales, like they think of Jason and SaaS and his
He'll
SaaStr
pop up
conference. And
somewhere.
it's like it's this whole brand. It's a very, very strong brand.
Yeah,
And I think for a lot of SaaS founders, like he would be like a top, individual VC to work with.
yeah. Got it. And what's your take on picking? Is it something? It's a judgment that gets built over the years, and how has it been for you in your case?
Yeah, it's definitely something that's been built over the years for me, and I think for most investors. Although I definitely like some people have like a good gut feeling, and others are more maybe like more data driven, or like. And for those people, I'm probably more in that camp. Like it takes a little bit longer to learn,
Mhm.
um, but I think I think the most important lesson for me in the early days was like to not get overly enamored with investment opportunities. Um, because what I found is like most VCs come from some area, right? Like maybe it's finance, maybe it's sales, maybe it's engineering. And usually whatever area you come from, like you get excited when you see somebody really good in that area,
Mhm.
right? So like I'm an engineer and in the first like 6 months or year of VC, every time I meet an amazing engineering team, I'd go back to my partners and be like, we should invest. This is like
Yeah.
such a good engineering team. My partners would be like, okay, but like, the business isn't going to work, or like nobody needs this product, or, there's like 50 competitors. And it was like a good like reminder to like, hey, like there's other stuff that matters and not just the one thing I know well in the beginning. And so I think that's been like probably the biggest lesson in picking is just spend a lot of time like calibrating, seeing what other investors think, not because you want to invest like with the herd, right? You want to have your own point of view, but you want to
Mhm.
understand like how do people with different perspectives look at a company, and maybe they had questions you didn't think about or insights you didn't think about that you should add to your repertoire of questions, or like things you're trying to diligence each time you talk to companies. And so you want to like early on calibrate with other investors. You want to meet more companies. You want to get a good sense of like here's what like a great business looks like versus good versus not good, or same thing with a founder or a sector. And then you want to track things over time, right? So you make an investment or you don't make an investment, check back on it in like 1 or 2 or 3 years. Obviously, if you made an investment, you're probably checking in more frequently. but like reflect on the investment after a year or two or three, and try to think about like, is it going well? Is it not going well? Why is it going well or not? And then do you want to keep like iterating on your diligence and picking as you spend more and more years in venture capital, as you compare notes with more and more other VCs and so on.
Got it. And Leo, over the years, of course, I'm sure, you've had mentors and you've learned from other people. And there's a lot of, of course, knowledge which is out there. Uh, what are you think are the biggest lies out there? What that means is initially you believed in those things, but now you've changed your mind on those things.
Ooh, that's a good one. I would say two come to mind. I think one is when I first got into the industry, everybody said like, basically like don't send founders feedback. Because the idea was like, well, like if they don't like your feedback, like they won't want to talk to you next time. And if you just don't say anything or you just say like, hey, it's too early, like you have a chance to invest in the next round. Um, I find that kind of like intellectually unsatisfying,
Mhm.
because like, hey, we just spent a few hours together. There's things I think are flaws in the business. I might be wrong, but it feels weird to like not share them because like if I'm wrong, like you could tell me I'm wrong. If I'm right, maybe it helps you like iterate on the company in some way. And so pretty early on, I started sending feedback to founders, and like people really liked it and actually said like not many investors send feedback, but like they appreciated that I did, even if they disagreed with the feedback. And then a lot of times, like those founders would come back like a round or two later, and like they'd like I'd be higher on their list instead of lower because I gave
Yeah,
feedback. So I think that was like one good myth. Um, I think the other one that comes to mind, this is more of just like talking to other VCs, and I don't mean this as like a way of insulting anyone because I think it's true for me too. But like most people don't really know what they're doing, and like they make an appearance like they do. But I think when you really dig in, like we're all just like trying to like fake it till we make it, and like
yeah,
very few people have made it. And so I think it's just also just taking advice with a grain of salt.
yeah,
Um, like I've joked with friends that on Twitter, like I wish like when VCs tweet advice, it would have like the IRR next to it, so you could see like do they actually know what they're talking about or not? Because I think a lot of times like things sound smart, right? It sounds like a good principled piece of advice, and like maybe it works and maybe it doesn't, right? And so I think part of it's like you just got to make up your own mind, and even if you know some really bad VC thinks it's a good idea, or some really good VC says it's a bad idea, like
yeah,
you have to just like make up your own mind and like think for yourself,
yeah.
because people just don't know. Like nobody knows everything.
Yeah, yeah, got it. And with this, extending on this, Leo, you're opening it up. Uh, how much do you think investing is random and luck?
I think there's I think there's a lot of it. Um, like I think it's a mix, right? And for some companies, it's more skill than luck, and for some, it's just luck. Um, like for example, on the luck spectrum, so like we invested in Flexport in the seed round, and we just got lucky because like one of my partners had a job that that had some logistics exposure before venture, and one of his friends was an early investor in Flexport. He introduced us to Flexport literally the night before YC demo day, and we got on a call with Ryan, and Ryan was like, "Hey, you guys write 200K checks. We have 200K left. Like, if you guys want to commit, like, this is the time, and like tomorrow the valuation's going up."
Mhm.
And like, so my partner and I were chatting, and we're on the phone. We were like, Ryan, this is a big idea. Like, my partner's had some exposure to it. Like, let's just do it. And it's like the only deal we ever committed to on a first call, like during the pitch. Um, but like that was just so much luck, right? Because like maybe if my partner hadn't spent time in logistics, like even though it's a great company, it would have been like, well, like we can't just make a decision on the first meeting,
Yeah,
right? Or maybe if they didn't have 200K left, maybe if they had a lot of room left, we would have taken more time, and then by the time we decided, then it would be really oversubscribed and we wouldn't get in. And so like there's all these things where like it's very easy to see how the story could have gone differently. And on the flip side, there's other examples where it's like, hey, maybe we saw something someone didn't see because we spent more time on diligence, or like we talked to a lot more potential customers or something like that. And that maybe that's more skill based than luck based.
mhm. Got it. And then you mentioned, Leo, that uh, we are just trying to figure it out, right? Not many people know what they're doing. Leo, for you, what's the hardest thing about building uh, Susa Ventures and Humba Ventures?
I think the hardest, well, I would say there's two. I think one is the market evolves, and so you have to evolve to stay relevant,
Yeah,
right? Like for example, like maybe you invested in semiconductors in the 90s or something, or 2000s. In 2010s it probably wasn't a great area,
yeah,
and then now it's a great area again. But like you can't just keep doing the same thing. It's like the markets ebb and flow, the venture labs landscape ebbs and flows, so you have to evolve with it. And I think that's related to the second pain point, which is I think the feedback loops here really suck, and it's like the hardest part of the business for me,
yeah,
because you make an investment today, you don't really know for like 8, 10 years if it's great or not.
yeah.
A lot of times, maybe in a year or two, you find out if it's not great. Uh, but on the flip side, there's companies where for the first 3 years it's really slow, and then it like suddenly explodes. Or
Sudden.
there's other ones where like it's exploding, and you're really excited about it, and then they're out of money because it turns out the unit economics are bad. And so you can't just look at like, well, how does the business look today, or like what was the last valuation. Like you have to just be patient and like try to understand what's going well and what's not, try to learn from it. But you don't really know the outcome until like 10 years later. And then the hard thing is, because the market's evolved, even if the market's validating 10 years later, well, maybe the market's changed, and like whatever made you invest or not invest in some company is like no longer relevant. So
Yeah,
I think that sort of like feedback loop is pretty painful.
yeah. Got it. Staying relevant and feedback loop is very long. It's brutally long. Leo, with this, my co-pilot is getting a bit restless. Alfonso wants to get in, and he wants to take it over. He's asking Leo, what's making you smile lately?
I would say like well, there's a couple things. My wife and I are expecting a kid this summer, so we're very excited about that. That's probably like the top thing. I would also say like I wrapped up fundraising for Humba, the second fund, a couple months ago. So that's been exciting because I could just focus more on companies.
Yeah.
And then the thing I really enjoy is on the SaaS side, like I think there's a lot of innovation, but it tends to be you're kind of like innovation on top of previous products. So a lot of times like you have like analytics 1.0 and then analytics 2.0 and 3.0, and
Yeah.
it keeps getting better and better. But like it keeps on this theme of like analytics. And so 10 years into Susa, I felt like I kept seeing iterations of similar ideas over and over a lot of times. What I really like about the deep tech side is like I feel like every company basically is like some new area of science or engineering that like I haven't previously explored or learned about. So I just
Mhm.
like really enjoy the process of meeting people that are like really good in these areas that are new to me, and then like learning about the areas, and then whenever I can, like investing and supporting the companies.
Got it. And Leo, is there a hack that you can't live your life without?
That's a good question. I don't know if this is a hack, but I really enjoy. Um, Actually, I'll give you a personal one and a professional one. So on the personal side, we got like blackout curtains a couple of years ago. They're like like $20 from Amazon or something. And oh man, like I think my sleep quality's improved so much. Because now like light doesn't get in, the room's always blacked out. It's just much easier to like to sleep. So that's been like a really good personal hack. On the professional side, we're an investor in a product called TextBlaze from like 3, 4 years ago.
Hmm.
But like there's TextBlaze, there's like ChatGPT, there's all these tools that simplify writing responses, or like like to emails and things like that. And so I found that to be a really good hack, because when Susa was starting, I didn't get a lot of cold emails. Like I didn't get a lot of emails. Like it was pretty easy to just reply to each one with a long, like a long answer. Now I get like a lot of cold emails. There's a lot of founders I work with, a lot of investors I work with, and so now it's like the volume of emails has gotten very large.
Yeah.
And so tools like TextBlaze or ChatGPT can make it a lot easier, to have like kind of a form reply, and I could tweak it a little bit, but it's like I can give somebody a useful answer,
Hmm.
but I don't have to rewrite it every single time, right? Like I can write it once and kind of retrieve it each time I need it. That's
Yeah.
that's been just like a really great time saving hack.
Got it. And Leo, if you're hosting a dinner, if you could invite three folks, uh, dead or alive, who would they be?
Um, well, that's a good question. I feel like it would be like a few of like the great iconic founders. And a lot of them are so different too. Like maybe like somebody like Steve Jobs that's more like design obsessed, and then somebody like Elon Musk that's very like science
Yeah.
and manufacturing obsessed, and
Yeah.
And just like, or like a Jeff Bezos, who's just like so amazing at growing like a cash machine. I think it would be fun, like really amazing to just like have dinner with like, three folks like that,
Yeah.
and understand like, kind of what motivates them, like, like lessons they've learned, like just try to like learn as much as you can from them.
Yeah.
Because they're both just like such outliers, even in a sea of like very strong outlier founders.
Yeah. Yeah. And Leo, we know you as an investor. What do your friends know you for? Who are you outside of work?
Uh, Honestly, probably still mostly as an investor. I'm more in the introverted side, so I spend like half my time investing and half my time like just like hanging out with my wife and like like take walks or watch TV or something. But we're
Mhm.
pretty like to ourselves. So I think most of my friends would probably just describe me as like investor and like family guy.
Got it. Got it. Love it. Leo, thank you so much for, coming on the podcast and sharing your learnings around investing over the years.
Thanks for having me. It was a blast, and really grateful that you invited me to chat.